Hi there. In this episode, we're going to talk about the Beneficiary IRA, also known as the Inherited IRA. We're going to talk about the difference between when a spouse inherits an IRA versus a non-spouse. We'll talk about when you inherit an IRA after January 1 of 2020, how that account is treated differently than if you inherited an IRA prior to January 1 of 2020. And the rules are going to be very much dependent on who you are as an individual that's inheriting the IRA. Or if you're the individual doing some estate planning and looking at who you want to leave your account to, you may want to take some of these items into consideration as you are naming beneficiaries to your IRA and other retirement account plans. All right, so first, let's define what is an inherited IRA or beneficiary IRA. Well, it simply is what it is. When you pass away and you leave your account to a child, grandchild, other family member, maybe even an entity like a charity, you're leaving the account to that individual or entity as either an inherited IRA or it could potentially become their IRA. And we're going to talk about that in more detail. So let's jump in here. It's important to understand and really designate the difference between a spouse and a non-spouse. Now, you will learn that there are actually three classifications of beneficiaries to retirement plans. The first is what's known as an eligible beneficiary. The second is a designated beneficiary. And then the third is a non-designated beneficiary. So you actually have eligible designated beneficiary, you have designated beneficiary, and then you have non-designated beneficiary. Now, I know that probably seems very confusing, and you're thinking, how in the world am I going to follow this process? Well, I would encourage folks to talk to their CPA, their financial planner, or possibly their estate planner, because their situations or nuances can very much be different than other folks. What I'm going to be speaking to here in this session is what applies to a majority of individuals or a majority of Americans. So let's focus on spouse versus non-spouse. So we have the spousal situation. So let's say, for example, Joe Smith passes away and leaves his IRA to his spouse, Sally Smith, who's still alive. So Sally Smith could actually take the IRA as what is known as a treat as own. So you could write down treat as own. So this is what it sounds like. Sally Smith would open an IRA in her name. It would be her account. And then the assets and or cash would transfer into her IRA in her name. It would almost be as if it was her account from the very beginning of time. Now, this is different than a non-spousal type arrangement, which we're going to get into in just a moment. Remember that the treat as own arrangement, the surviving spouse opens an IRA in their name. The common question I get at this point is, well, if I have an existing IRA, can I simply consolidate the accounts together? And the answer is yes. Now, you have to wait, of course, until spouse A passes away for you to do that. Another common question I get is, can two spouses combine their IRAs together? While they're both living, they cannot do that. When one passes away, then they can use this treat as own arrangement. Now, would there ever be an instance where a spouse would not use the treat as own and they would take the account as an inherited IRA? And the answer is yes. In some circumstances, this does occur. The most common example is for a spouse that is more than 10 years younger. They may elect to take the account over a 5-year period or distribute the account over a 5-year period because they may be under the age of 59 and a half. And remember, if you're under the age of 59 and a half, there's a 10% penalty and ordinary income taxes on distributions. But if taken as an inherited IRA, they can actually avoid the 10% premature withdrawal penalty if they elect for that particular status. All right, so that's the spousal inheritance process. Last but not least, let me mention that for equity trust customers who have alternative assets in their IRA, like gold and silver, cryptocurrency, real estate, private equity, venture capital, other types of alternative investments. In most instances, the surviving spouse has to open a self-directed IRA with equity trust in order to receive those assets, those alternative assets. Because, see, most financial institutions will not hold alternative assets. So one of the most common questions I get is, I have an account with XYZ financial services company, but they only hold stocks, bonds, and mutual funds. how could I take these alternative assets and move it over into this other account? And the answer is they can't. So that's where they would need to open an account with equity trust in order to intake those assets in cash. All right, let's now talk about the non-spousal inheritance. Now, this is different because we're now in a situation where it's going to become a true inherited IRA or beneficiary IRA. Now, how do you know whether the account is a beneficiary IRA or an inherited IRA? Well, generally speaking, your account statement will indicate this. So whoever your custodian is, whoever the financial institution is that has the IRA under custody, they will have listed on your account statement, listed on your account, this inherited IRA or beneficiary IRA titling. You'll actually see the term Benny IRA quite frequently in financial services. And Benny IRA generally is going to indicate to you that this is an inherited IRA. So what happens when a non-spouse inherits the IRA, it becomes an inherited IRA, and then you have to follow a whole different set of rules, which we're going to talk about in just a moment. So think a son or daughter or a grandchild or maybe other loved one inherits an IRA, it becomes an inherited IRA. And it's not in their name personally, but it's in their name, beneficiary IRA of the deceased individual. So for example, let's say Joe Smith passes away, and instead of leaving it to his surviving spouse, Sally, he decides to leave it to his son, Joe Jr. So now it would be the Joe Jr. Benny IRA of Joe Smith. That would, in fact, be what is listed on the account statement, or similar type of format would be listed on the account statement with the financial institution, designating that as a beneficiary. That way, that individual knows how they need to proceed with their requirement of distributions or when they need to withdraw the account. All right, so important to understand the difference between a spousal treatise own versus a non-spousal inheritance. Now, is there ever an instance where a beneficiary could not take the account as an inherited IRA? Well, there are instances. There are what are known as non-designated beneficiaries. So certain types of trusts, certain types of charities are non-designated beneficiaries, and they would not qualify to actually take the account as an inherited IRA. There are other circumstances where maybe a Roth IRA is being left to a third generation after it's already considered an inherited IRA with the first generation. And in that instance, it would be forced distributed. So you will learn there's some nuances and different rules that you need to make sure you understand based on your own individual situation. Okay, so now that you understand the difference between spouse and non-spousal beneficiary IRAs, let's now talk about the rules pre-2020, pre-Secure Act versus post-Secure Act. So if you inherited an IRA prior to January 1 of 2020, the way it would work for a spouse is the rules would all be the same, just like they are today. No difference. So it's a treatise own, it's that individual's IRA. If it's a traditional IRA, they have to take requirement of distributions. Now that starts at 73. It was at 70 and a half, then it went to 72 on the Secure Act in 2020. Now, per the Secure Act 2.0, it's now 73 years of age. And then it's going to eventually go up to 75 by the year 2033. So under the old rules and the new rules, the spousal treatise own stayed the same. What changed, a major change, was with the non-spousal inheritance. So prior to January 1 of 2020, prior to the Secure Act, if you were a non-spouse and you inherited an IRA, you had the privilege, or you could even say luxury, of actually taking the money out as what they would refer to as a stretch. So you would take the money out, if you elected to, you would take the money out over your life expectancy using your life expectancy table published by the IRS. In most instances, for a non-spouse, it would be the single life expectancy table. So there would be a calculation you would do every year, and you'd be required to take a distribution from that account every single year, whether it was a traditional account or a Roth account. How do you do the math? Well, there are lots of calculators online. You can even go to the IRS website, irs.gov, and find the life expectancy table and learn how to perform the calculations, or talk to your CPA or financial planner with respect to how to do the calculations. But what will happen is there'll be a life expectancy based on your age, and you take the total portfolio value of the IRA and you divide it by your life expectancy, and then that would give you the number that you would have to distribute in that particular year. Again, these are what are known as required minimum distributions. All right, so now you know that prior to 2020, if you inherited an IRA, you can take the money out over your lifetime. There are other options, by the way, than the take it out over your lifetime, but most people will find would have elected to take the money out over their lifetime. Obviously, you could take all of it out if you want, or you just take your required minimum distribution. All right, now once January 1, 2020 came around, the Secure Act 1.0 kicked in and changed the inherited IRA rules. So in most instances, a non-spouse, now there are 3 exceptions to this that I'm going to cover in just a second, but in most instances, a non-spouse that inherits an IRA post January 1 of 2020, they are forced to distribute all of the money within 10 years, whether it's a tax-deferred traditional IRA or a Roth IRA. They have to take it all out within a 10-year period. So once they get to that 10 years, they got to have all the money out of the plan. Now, for a Roth IRA, as you know, that's after-tax money. And so there's really no burden left to the heir, to the non-spouse. They simply take the money out whenever they want. Maybe they continue to grow it for 10 years, and then they take it out at the 10-year mark, and they pay 0% tax. But for people that have a lot of tax-deferred money, traditional IRAs, SEP IRAs, simple IRAs, 401ks, all tax-deferred, in those instances, if they leave that account to their heir, there could be a significant tax burden over that 10-year period. And if they waited until year 10 to take all the money out, there could be a rather large tax burden. So it's important for heirs and families to really get together with their CPA and financial planner and strategize around what's going to create an optimal situation for themselves and their loved ones that are going to inherit the account. One option that a lot of Americans are exploring is what's known as a Roth conversion. So converting the money from your tax-deferred accounts into your Roth accounts, pay the taxes now, so that your heirs, your children or grandchildren or other loved ones don't have to pay taxes upon the distribution, despite having to withdraw all the money within that 10-year period. Okay, so that's just one sort of tip that you can check out and research more on. Again, that's known as a Roth conversion. Obviously, there are tax implications here, so you want to make sure you pencil this out. Maybe talk to your financial planner or CPA and determine what's going to make the most sense for you. All right, now, what happens if the non-spouse heir is within 10 years of the individual that passes away? Now, this is interesting, and this gets into our eligible designated beneficiaries. So remember when I talked about 3 classifications of beneficiaries? There are eligible designated beneficiaries, and then non-designated beneficiaries. So these eligible designated beneficiaries would be a spouse, just like we talked about. All the same rules apply. Another eligible designated beneficiary could be someone who qualifies as a disabled or chronically disabled individual. And then the third, this is the interesting one, the third is anyone who inherits the account that is within 10 years of the individual passing away. So for example, let's say I passed away and I left my IRA instead of to my spouse, but I left it to my brother. Now, my brother is within 3 years of me. So my brother could inherit the IRA as an inherited IRA, and he's not going to be forced to distribute all of the money in a 10-year period. He'll actually be able to distribute the money over his life expectancy based on the IRS published life expectancy table. This is an interesting nuance here, and unfortunately, I find a lot of people miss this. A lot of people miss it, however, because most people with their IRAs, if they're not leaving it to their spouse, they're leaving it to who? they're leaving it to their children or their grandchildren or other younger generations that are well beyond that 10-year rule. Okay, so just make sure you pick up on that, especially for those of you that maybe don't have children or other loved ones that are much younger, and maybe you are going to leave your IRA to a surviving sibling or cousin or somebody that's within that 10-year window. Okay, so we talked about the spousal treat as own. We talked about the non-spouse, and of course, the difference between whether you inherit an IRA prior to January 1 of 2020 or after January 1 of 2020, which again is known as the Secure Act. Last but not least, required minimum distributions. We've brought that up. Required minimum distributions, while you are still alive and it's your IRA, is going to be dependent on your age. It's going to be dependent on whether your spouse is more or less than 10 years younger than you. There is a different life expectancy table that you have to use if you have a spouse that is more than 10 years younger than you. There's the uniform life expectancy table, there's the single life expectancy table, and then there's the joint life expectancy table, table 1, 2, and 3. And so what you want to do is go to the IRS website, and you'll find on irs.gov, you can search and look for, okay, here are my circumstances, and here is the specific required minimum distribution table. With tax-deferred accounts, traditional IRAs, that would be SEP IRAs, simple IRAs, 401ks that are tax-deferred. Once you turn 72 under the Secure Act 1.0, you have to take required minimum distributions. Under the Secure Act 2.0, as of the year 2023, that age went to 73. And then by 2033, it will go to 75 years of age. Now, keep in mind, this is only for tax-deferred accounts, traditional IRAs, 401ks, SEP IRAs, simple IRAs. Roth IRAs do not have a required minimum distribution. So if you have a Roth IRA, the money goes in after tax, it grows tax-free, you have no required minimum distribution in your lifetime. All right, so that being said, I hope everybody enjoyed this session and got a lot out of understanding some of the rules around beneficiary IRAs and inherited IRAs. I understand they can be complex at times, so I encourage you to do your due diligence. We have other video training on YouTube, and until the next training video, keep leveraging compounding interest in the absence of taxation.